This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. The Planet MicroCap Showcase Vegas, happening April 30 through May 2nd, 2024 at the Paris Hotel and Casino, is around the corner, 2 weeks away. Our event brings together the best investors and thought leaders in microcap, quality microcap investing opportunities, and above all else, the most fun and highest return on your time that you could ask for. If you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is Joe Lucosky. He's the managing partner at Lucosky Brookman. You might take one look at this title, and as an investor, you might wonder, why should you care whether a company decides to uplist, crosslist, or even delist? What do these terms even mean? Why is the company wasting their time even considering any of these corporate actions? If you've ever asked yourself this question, whether you're an investor or even an issuer, this is without a doubt the episode for you. Even if you've never thought about these topics, I think you'll find our conversation quite fascinating. In the world of micro and nano-caps, this conversation is happening in every boardroom. Should we uplist to the NASDAQ from OTC Markets? What's the new U.S. listings program at CBOE? Should we delist to the OTCQX, QB, or the Pinks? Is it too soon for us to uplist? Should we cross-list onto OTC or NASDAQ? Should we do a simultaneous raise with uplist or crosslist? How will our investors react to this? I've known Joe for years and has given multiple keynotes on this topic at our recent investor conferences, including a keynote Q&A with Eric Sloan from the CBOE at the Planet MicroCap Showcase Vegas happening on April 30, 2024. That's coming up. You don't want to miss that. This is Joe's topic. It's his bread and butter, and he truly enjoys helping companies understand what makes the most sense for them. I think we do a good job covering every angle on the topic, but look, I invite you to give it a listen, and I would love your feedback on this one. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Joe Lucosky. Joe, thank you for joining me today. How you doing, man?
Hey, Bobby. Thank you for having us. Very happy to be here.
Absolutely. It's great to have you on. And listen, we've been planning this one out for, I think, at least a year. And I think it was perfect timing because there's so much for us to cover, from uplisting, NASDAQ delisting, just a whole host of stuff. And look, I also want to make sure everyone knows, for full disclosure, Lucosky Brookman is a premier sponsor at our upcoming event in Vegas, Planet MicroCap Vegas, Planet MicroCap Showcase Vegas, April 30th through May 2nd. And, I wanted to have Joe on purely out of interest because this is one of the hottest button topics out there is uplisting, new exchanges available now for small micro nano cap issuers, issues with various exchanges that are currently in existence. There's just a lot that I feel like has been talked about anecdotally, but now I wanted to bring on the guy who's actually done 2 keynotes for us in talking about uplisting. So with that, Joe, I want to start off with your background. Maybe provide us a little bit about the firm as well as some clients that you serve.
Yeah, sure. Thank you. So we, as you know, are a corporate finance and securities boutique located out here on the East Coast, New York, New Jersey. And we have, I think, a very interesting background because we really spun out of Am Law 100 law firms early in our careers. We're going now into our 14th year. And almost all of our senior people have one time or another worked and have been classically trained at these large law firms. Myself, I grew up at Cahill Gordon and Seward and Kissel, and a lot of my partners and colleagues have grown and been trained at similar firms. And really, about 14 years ago, we spun out to create a boutique-style firm that serves that lower to middle NASDAQ, New York Stock Exchange market. And we've grown over the years, too, from the OTC up to the New York Stock Exchange, NASDAQ, and now CBOE, the new sort of third higher exchange here in the United States. And, our focus early on was capital markets only, M&A, lending, securities. And we really have broadened that focus to be, I don't want to say full service, because I think that would be, that's what a lot of firms say, but we're definitely business focused. So we have a great commercial litigation group. We do a lot of white collar work, securities enforcement, which I know nobody likes to talk about, but it's a necessary part of the business. We've grown out our M&A, lending, securities. But at the end of the day, Bobby, we are hyper-focused and core-focused on the microcap. And that is why, what brings us together both as friends and ambassadors to the industry and constantly communicating and collaborating on these issues, because we care about the community. So as you said in your opening, we are hyper-focused on uplist, cross-list, and microcap IPOs.
Absolutely. So let's start there. For those that have been unaware or maybe haven't even been paying attention to some of the trends that's been happening in the small micro nano cap space with regard to both uplisting, delistings, delinquencies, all of that. Quickly describe what we mean by uplisting, cross-listing versus, let's say, an IPO or traditional IPO.
Sure. So how we define it, and again, this has been an evolution, because 5 or 6 years ago, there was really no good parlance for these types of transactions. We had to, as much as focus on the practice, we had to educate the market on the language. So we think we have a good handle on the definitions, and I think the broader industry has adopted the Lucosky Brookman definition of these transactions, both formally and colloquial speaking. So for example, what we define as an uplist transaction is a domestic U.S. company that's traded on a trading platform like the OTC. So they're actually uplisting. They're listing up to a national exchange. When we refer to cross listings, we generally think of a company that is not U.S. based and they're trading on some foreign platform, whether that's in Canada or over in Europe or somewhere else. Mainly Canada, that's very hot, very much a part of the space. And they're cross-listing. Even if they're dual listed on the OTC, we still would consider them a cross-listing from their home country to the NASDAQ, New York Stock Exchange, or now onto CBOE. And of course, a microcap IPO is really a private company, with a market cap on day one less than $300 million. That's how we define it. That's how we track it in our data, which I know we're going to talk about hopefully in a little bit. But those are the three categories: the uplist from domestically, the cross list from foreign trading platforms, and the microcap IPOs, which are private to public transactions directly to a higher or senior exchange.
Beautiful. Now, to give even more context, the next layer from there, in your opinion, having done this now for a number of years, why do companies engage with a firm like Lucosky Brookman or any firm that does uplistings? Why are they doing the uplisting and or the cross-listing?
Well, I think very different. Companies that engage us, again, there's a lot of good lawyers out there. We have a lot of friendly competitors who we think are very, very smart attorneys. I think though firms engage us for different reasons, because we are smart attorneys. We all have practice and classically trained at, some of the best law firms in the world. But I think it takes more than that, especially in this market environment. Like that's where
I said it to be unbiased,
Yeah.
Okay.
Well, no, but it's true, because I do think there's a lot of good lawyers out there, but I think there's a lot lacking in our space. What I mean by that is, especially in a challenged market, when things are tougher, deals are harder to close. The regulators are clamping down and sometimes not being as user-friendly as we would like them. Being a smart lawyer is not good enough. Reviewing the documents and getting all the commas and periods and disclosures is not good enough. You have to take it a step further. And that's where I think Lucosky Brookman really has made our name in the marketplace, because we're extremely proactive. We look at ourselves as quarterbacks. We lead transactions. We're trying to serve our clients every day at the highest level. And there's really more of an energy and an inertia that goes into these transactions, where we're not really sitting in our hands waiting for the next step, waiting to be told what to do. We are a lot of times leading from the front, meaning we're leading the bankers, we're leading the auditors, we're pushing the deal teams, we're making things happen. And especially, in 2021, anyone could have done a transaction. I mean, you basically wake up and you're a securities lawyer and you're doing an IPO. In 2024, very, very different. It takes a perseverance, a level of grit, a passion to really stay the course and to work with all the different constituencies to get a deal done, because there are a lot of diverging interests on every deal. And it's not enough to just go through the motions. You have to lead from the front. And that's what we do. And that's what I think makes us different in this industry.
All right. So, I mean, getting to my question specifically, because clearly you just outlined, like, all right, it's clearly a pain in the ass, to put it frank, to uplist and or crosslist. So why would a company go through the hassle?
Thank you. I got so caught up in.
I know you heard me say. I know you heard.
Totally
me,
forgot.
I got
you led me down that path.
That was my fault.
So here's the thing. I mean, look.
I give you an inch, you take a mile. Sorry.
It's expected. Well, look, when you love what you do and you're passionate about your clients, you want to serve them at the highest level. I could talk about this in my sleep all day, every day. And my kids will tell you the same thing. They make fun of me. But to answer your question, look, uplisting and crosslisting has had a very tough go over the last year or two. And there's a lot of reasons for that. To answer your question about why a company would uplist, and this is a wonderful question because it is a topic of serious debate in our industry right now. There has been a lot of crosstalk between the various trading platforms, namely the OTC and the higher exchanges like NASDAQ, New York Stock Exchange, and to some extent CBOE, and why companies would leave the OTC, why they would want to uplist to NASDAQ and New York Stock Exchange, why companies would even want to IPO on the New York Stock Exchange or NASDAQ. And really it comes down, I think, and the theme that we constantly see over and over is access to capital. A lot of these companies want to grow. They desire to grow. They have an obsession to grow, but you can't grow without capital. So the companies that are private clearly talk to bankers and consultants and others who are more willing to find them money if there's an exit or a liquidity or something other than being locked up privately. Now, we can debate at what stage companies go public. Some of them should probably stay private a little bit longer. Some of them probably should stay on the OTC a little bit longer. But when there is this constant push to raise capital, to grow your operations, this constant desire to have liquidity, especially if you're on a trading platform that's not the New York Stock Exchange or NASDAQ, those forces weigh heavily on management, I believe, and the board. And when there is money available, if you list or uplist or cross-list, that's a serious consideration that CEOs, I think, take very seriously, because without capital, they're not growing. Now, I know there's a lot of discussion and debate whether companies list too soon, go public too soon. And, nobody really knows what is too soon. You ask 10 people, you get 10 different answers. But I will tell you, it generally revolves around capital raising and liquidity. And if we accept for 1 second as true that capital will help grow a company, right? We can't disparage management and say, hey, they're just going to piss the money away, because we have to accept some things as true. So if we accept that money and liquidity are good for companies, then it's on management to execute. So a lot of these companies that potentially maybe went public or listed too early, as some of the critics say, well, that's just, some of it's a failed business plan, some of it's failed execution, some of it wasn't enough capital. But I understand the argument, but there has to be a solution. Staying private or staying on the OTC can't just be, hey, stay there forever without capital, without liquidity, and just figure it out. So I understand the urge. It may not be a perfect world, but my view is at least they're trying to make things better for shareholders. And that is sort of the predominant feeling, I think, with a lot of our peers that we talk about daily.
Perfect. All right. This is a great launch pad to talk about some of the things that have been debated and talked about, amongst buy side, amongst, what I hear anecdotally from investors as well. When, you see a company that did uplist maybe a little earlier, because one of the things that's been trending up, especially since I've been in the business for 13 years now, is that the costs of being public have continued to go up and up and up. And then now when you talk about companies going uplisting from OTC, that's going from what, 12.5, 15K a year to now, NASDAQ, what is that, like 150 a year nowadays, and some of the additional costs involved with not just getting there, but then maintaining it, so that's also something that's been brought up a lot from some of these smaller companies. They're like, man, like, maybe I should just stay on OTC until I continue to grow the business. But then you bring up the other point of like, well, sometimes it's much more difficult to get the capital they need in order to grow. But love to address some of those concerns as well.
Yeah, let me tell you, look, we are big fans of the OTC. I love the OTC in a lot of respects, but I'm also a big fan of results and execution. So when you combine the two of those, if a company has the ability to stay on the OTC and raise real capital, not just pay lip service to that, if they have the ability to stay on the OTC with reasonable eyeballs watching their company and some liquidity, then I am all for staying on the OTC and not listing too quickly. The problem is that doesn't always play out in reality. As far as your question about expenses, to me, it's not just a function of the fee that you pay the platform or the exchange. Those are sort of sunk costs. What
Right, of course.
I think are really good to keep your eye on the ball is putting together a compliance package for these companies, both for auditors, legal, transfer agent, and others that makes sense. I see these companies, again, no disrespect to big firms. I grew up at a big firm. I was classically trained at one of the greatest firms in the world, and I respect big firms and what they do. But the cost structure is out of control.
It's
and I'm not
crazy.
saying that we're the cheapest or because we're not. But there has to be some reality brought back to the situation. When I see AmLaw 100 firms representing an OTC company, charging them $25,000 a month for the compliance, I fall off my chair. I mean, there is a way, and this is what we do. This is what I was talking about earlier, Bobby, when we are more than just process-oriented lawyers. We are quarterbacks in the process. And what we do is we will design a compliance package on a fixed fee basis that is really commensurate with the level and stage that the company is at. So for example, maybe I'm just making it up, a couple $1,000s a month for sort of SEC compliance all the way up to $5,000 or $10,000. That seems to be the going rate. When I hear $20,000, $30,000 a month, that's crazy. Every company doesn't need Ernst & Young as their auditor. There are very good microcap auditors who do a good job, actually do the job, because there's some that don't do the job. You need to stay away from them too. And that's what we're good about doing. Opening our Rolodex, making sure best-in-class providers are available, but for a good cost. So it doesn't have to be, give away the farm and the piggy bank to the largest, biggest names. There are good players in our space that can do things cost effectively.
Hey, Joe, real quick to follow up on that, because there was an article, or I think it was a thread on MicroCap Club that that caught my eye. When I'm pretty sure it was an article where there was a debate on what actually is the cost of being public nowadays. And I know that varies, right? Depending on market cap, a lot of different things. But what would you say is kind of that sweet spot or I don't know if it's sweet spot, but what do you think is that, I guess, the real amount that companies should be spent or the most that they should be spending?
Well, I'll tell you this. If you're in the OTC and you're fully reporting with the SEC, there's your core cost. There's legal compliance, which generally, again, should be, $3,000 to $5,000 a month generally. Maybe a little bit more, maybe a little bit less for legal compliance. Then there's audit costs. Depending on the size of the company, revenue, testing, that can be anywhere from 50 to 100, 150 grand a year, depending on the size and volume of transactions. And then you really have to think about your board. Are you compensating them in equity or cash? Generally, it's equity on the OTC, stock options, maybe a little bit of cash. Once you graduate to NASDAQ, that can change a little bit because of committee structures and more work. And then, I don't really count things like investor relations, public relations, because, while you may want to get the word out, you can put out press releases. That's certainly a good cost. The platforms and the exchanges should be doing their job with eyeballs. You don't need to be spending all this crazy money. Now, I know companies do. It's a necessary evil. I'm not naive to the fact that they need to get exposure. All I'm saying is it can be done in a controlled way that you're not spending $500,000 a year on compliance. You're spending $200,000 or $300,000 a year on compliance until you get to a higher exchange, raise enough money, and grow your business and platform where you can now afford these additional costs.
Absolutely. So another question I actually wanted to go down, and that was a perfect segue, was, one of the reasons you also mentioned that a lot of companies do explore uplisting and or cross-listing is liquidity, and I think one thing we've definitely seen with NASDAQ in particular, with a lot of, potential delistings going back on OTC or something like that, is that liquidity is not an automatic once you're on NASDAQ, NYSE, or any of these senior exchanges. So how do you address that nowadays when companies are starting to explore the uplisting or cross-listing process?
Well, look, it's not so much just about volume. Volume is one piece of it, right? Because that is the result. That is the execution part. Here's what I'll say. I talk to a lot of CEOs on the OTC who are really torn. Do they stay on the OTC? Do they uplist? Our advice is always, look, stay on the OTC, talk to the OTC, get their opinions on how to make things better for you where you currently are. And then if that doesn't work, let's explore a national listing. But what I'll say is this: when you do get to the NASDAQ and New York Stock Exchange, a world of opportunities open up for your company that don't exist on the OTC. It's just fact, okay? I don't know any broker-dealer that even looks at or covers OTC companies. They're afraid of them because of FINRA, right? I don't know any wealth manager that would recommend an OTC company. Obviously there's some exceptions. Again, they're afraid of them, can't do it, can't buy penny stocks, can't buy stocks on the OTC platform. The bankers that I speak to, the 42 banks in a microcap space, now all of them are looking for OTC companies to uplist. Nobody is looking for OTC companies to finance on the OTC. It is not a market that exists. Now, I know there's a lot of debate here, Bobby. You talk to people at OTC Markets, they will tell you the exact opposite. And I'm fine with that. I just want to see the data. Show me the data. I'm a data guy. And I don't see that data. I'm open to hearing about it, seeing about it. And like I said, we totally respect the other trading platforms. But when you get to a national exchange, everybody is knocking down your door. Wealth managers, bankers, other brokers can now look at your stocks. Now, again, there's some price sensitivity depending on where you fall and what the rules are. Analysts can now look at you. All the IR firms want to talk to you. There's a whole range of possibilities. So if you have one platform that's either foreign or domestic that you don't have those opportunities, and then higher exchange where you do have all this window of opportunities, I don't know what the end result will be. Like you said, liquidity is not guaranteed, but geez, I mean, there's a lot more opportunity on one level than there is on the other.
100%. Well, this also ties into something else that's been brand spanking new in the last 9 months here within our ecosystem, and that's CBOE. CBOE now opening up their U.S. listings. I mean, they're traditionally, they own or now they own what was the Neo Exchange, so they have about 70 listings in Canada, but in the U.S. they've traditionally been known for ETFs, obviously commodities, whatnot. So now that they're opening up this U.S. listing side of the business, that's because I think that's what's been troubling a lot of folks that may be considering uplisting, but they're like, man, I'm going from spending this amount on OTC to now I'm going, whoa, like there's a little bit of sticker shock. And where CBOE, there's a lot of things and nuance with the CBOE offering versus going to NASDAQ or NYSE. But price just on alone is not as, oh, okay. People breathe a little bit of a sigh of relief, at least on that front. But, I'd love to get your opinion on CBOE, their new entrant, this new option finally available. So let's start there.
Well, yeah. Well, listen, I got a lot to say on this. I am a big supporter and a big fan of what CBOE is doing. It's not because I love CBOE or automatically love them. It's because it's good to have another alternative. It's good to have competition in our world. And I say that, I'm actually coming out with an article here through Forbes Business Council here in the next week on comparisons between CBOE and the NASDAQ and how their listing process is implemented. Because while on their face, they seemingly have similar listing qualifications, the way they are implemented are radically different. And I know this isn't the time to talk about a lot of those differences.
Please, can you? I want that so bad. I know it's in your article, but I'll clip this. I'll clip this. So where's Bill Simmons? Do you listen to the Bill Simmons podcast? Well, this is the TikTok cam. Let's go, man.
Yeah. Well, look, let me tell you first why I think CBOE is a good alternative, because competition is good. And NASDAQ over the last year or two has really, been difficult on certain levels to get deals cleared. And that's just not me speaking. That is the industry speaking, okay? I'm not making a personal judgment. I recognize they have over 90% of the listings market, especially in the microcap. So they have the hardest job. The SEC, others are always looking at NASDAQ to do better, control things more, fix things. So I recognize they are in an absolutely tough spot. What I think, though, as a community, we can do better to help them is to have more communication, more transparency. I mean, the industry thinks, for better or worse, there's, a few people that sit in Rockville, Maryland, and they make all these decisions without any input from the higher ups at NASDAQ. And I know that's not true. There's a lot of smart, good, decent people engaged in this process, just trying to figure out how to list companies and stay out of the crosshairs of the SEC. That said, the industry, I believe, feels that NASDAQ has become very un-user-friendly over the last year or two. And they come up with these rules, like randomly sometimes. Like, for example, one day which they came up with maybe a year ago, they single-handedly killed the Uplist market for a period of time. There used to be a rule where you could simultaneously do a reverse split and list on NASDAQ. Well, one day they woke up and boom, it was gone. Now you couldn't do that. You had to either trade for 5 days, 10 days, 20 days, 30 days. Sometimes it depends on, how the person wakes up that day and gives you an amount of trading days. It's like the craziest thing in the world. Now, I'm exaggerating a little bit, but that's what it feels like. And that's what the industry feels. So if you're an uplisted company and you do a reverse split because you have to consolidate to meet your $4 stock price or $5 stock price, and now you have to trade for 10 days on the OTC before they will list you, makes no sense. There's too much of a risk in between those 10 trading days to actually then slip back down below the NASDAQ qualification rules. And to me, is the craziest thing. The NASDAQ is out there, and everyone is out there promoting that there's a more efficient market on the senior exchanges. There's more liquidity. You can't trust the liquidity of the OTC or foreign exchanges. And then they're demanding that you trade on the lower exchange for 10 days as some sign of liquidity to then meet the rules of NASDAQ. It's like, totally counterintuitive. So things like that, I think, have frustrated the broader markets. And I get calls all the time from investment bankers, lawyers, consultants. I mean, we do a lot of what we call NASDAQ special counsel work, where we will come in. We're not underwriters counsel. We're not company counsel. We're very much NASDAQ special counsel to get the deals cleared. Because there's a little bit of art in the process now. It used to be NASDAQ will clear you from the company side of listing. Well, now you got another one. Now you got to clear the deal. So there's really two qualifications now when you do a NASDAQ deal. So this is a long-winded way of saying that CBOE has come on the stage. They have come out with a very user-friendly platform. Their interpretations of some of the things in CBOE seem to be much more user-friendly. The question is this, though, Bobby. Well, they have put up a couple deals, and they're not immune to the economy and the broader markets and global affairs. Some have done okay, and some have not done okay. But again, not out of the realm of comparable to what NASDAQ and New York Stock Exchange are doing in the MicroCap. But the question is this. Will the bankers, will the money, will the institutions ultimately follow for the long term and create that liquidity path for CBOE? If they do, and bankers keep listing, and funds keep investing, and retail comes in, I believe CBOE will be a very, very fierce competitor in this microcap and just all cap, not just microcap, but specifically because this is our world, in the microcap world. And they're going to take lots of market share from NASDAQ and some from the New York Stock Exchange. Again, it's about 90-10 right now, NASDAQ, New York Stock Exchange. And NASDAQ probably doesn't care. Maybe they care. Some people say they care. Some others within the exchange say they don't. But again, the jury is out. We're very bullish. We're happy what they're doing. But it remains to be seen if the money and institutions and investors will continually follow and stay the course for these new deals.
That's a very fair point when it comes to CBOE. And look, for full disclosure, CBOE is actually also a premier sponsor for our upcoming Vegas conference. Actually, Joe, you're going to be doing a keynote Q&A with Eric Sloan from CBOE talking about the new
I can't wait. I'm sharpening my pencils. I got amazingly tough questions for Eric and CBOE, and we're going to bring the house down.
Good. I'm stoked for it. It's going to be really good. But, speaking to, that article that you have coming up, you talked about kind of the main drawbacks were really the frustrations that have been with some of the NASDAQ, NYSE, now this CBOE offering, which I 100% agree. We needed some kind of competition out there. But you said on paper, CBOE, NASDAQ look very similar, but it's in the implementation that there's the nuance and differences.
By the way, you're an excellent interviewer, because I tried to sidestep that question. I know. You brought it right back to me.
Hey, man.
Relentless.
I wasn't going to let you slide on that one.
Relentless. Well, let me just say it this way. So most of, as you know, what we call as practitioners, or at least I feel like I sort of coined this sort of phrase. We call it the core four requirements of listing. Now there's dozens of requirements, both quantitatively and qualitatively, but what we call the core four are, the shareholders equity requirement, the stock price requirement, the public float requirement, and the number of shareholders requirement. Those are what we call the core four, or at least I call it the core four. And that is what every company has to sort of meet. So if you look at the sort of across the board, most of the exchanges, they all look very similar. I'll just run through this very quickly. Generally, NASDAQ and CBOE, you need a, shareholders equity of about $5 million. Share price, $4, maybe $3 on NYSE Amex. You need about 300 round lot shareholders, and you need a public float of 15 million. That's pretty standard across the exchanges. But when you go to implement how those are regarded in the initial listing process, at least with CBOE, they are radically different. So for example, I talked earlier about simultaneous reverse stock splits and how NASDAQ's moratorium on that has all but killed the Uplist market. Well, CBOE is more than happy to do a simultaneous reverse stock split and listing of the new money on an Uplist. That is a world of possibilities open. That is going to single-handedly bring back the Uplist market, and I believe they're going to gain a lot of market share until they change that rule, or as long as it's still open. The other thing is that on the shareholders' equity, everybody stresses about the $5 million shareholders' equity. Well, NASDAQ has this burn rate calculation, which really nobody knows about and everyone forgets about. You take your shareholders' equity off your balance sheet, it has to equal $5 million. But then they apply this complicated, sort of 18-month backward-looking burn rate calculation that actually subtracts from your shareholders' equity. And then, by the way, the rules change on that too. What you count, what you can add back, what you can't add back. There's somewhat no rhyme or reason to all these new rules that come out, with NASDAQ. So that catches people off guard. CBOE, they don't have that rule. Your shareholders' equity comes off your balance sheet. It is what it is. We're not going to twist ourselves into a pretzel and pretend that expenses from 18 months ago are similar to expenses now and ding the company's shareholders' equity so you can't list. The other thing that's really important is that CBOE seems to be following the trend, or not the trend, but the application of public float like the New York Stock Exchange. So, for example, NASDAQ will not count lock up or leak out shares in public float. So if you need $15 million of public float and you have $5 million of, say, legacy shareholders who are locked up, NASDAQ's not going to give you any credit. So you still have to raise $15 million. Where the New York Stock Exchange, at least with leak outs, they'll credit that $5 million to public float because, you can still sell. CBOE seems to be trending in that direction. So it puts less pressure on offerings. So instead of having to raise $15 million, and maybe that's too much money at a lower valuation, you can now raise 10 because they're giving you credit for the $5 million that is free trading, but it's just locked up or leaked out. And another big difference, which is sort of near and dear to my heart because I wrote an article for Forbes on this too, about the NASDAQ, their stance on anchor investors. And again, I just want to say they have a very tough job. Everyone over there is doing the best they can to stay out of the SEC's crosshairs, to provide us a efficient and vibrant market. But there really has been this trend to stay away from and not support anchor investors. Now, they will not say this. This is my words, not theirs. I'm just telling you what I see in the industry. I'm talking to dozens of lawyers, dozens of investment bankers. This new concentration and distribution analysis that NASDAQ does disfavors anchor investors. Bobby, you know this. For years and years and years, we'd have an emerging growth company. We get an anchor investor from a Wellington or T. Rowe Price or a Gabelli, and we're high-fiving, jumping on conference tables saying the company's arrived, taking 20% of the deal. Wow, we got real investors, smart people behind us. Well, you can't do that anymore, especially in the microcap deal. Anchor investors are out of favor given NASDAQ's new concentration and distribution analysis. So if you really can't have, and we don't know what the percentage is, no one will tell us, kind of make it up as you go along. It's kind of like if you see it, you know it, or you know it, you see it. It's crazy. So we have to make sure that, no investors are really over like 5-6%, maybe 9%. You got to be really delicate in how you handle that second part of the qualification now, as we talked about earlier. You qualify the company, now you have to qualify the deal. And that's where CBOE is taking a very different approach. They're saying, look, if you have an anchor investor, as long as you have a certain percentage of your deal from outsiders, meaning totally arm's length investors, we'll allow an anchor investor. We don't care. We think that's good for the capital markets. We think that's good that smart people with a lot of money, with good degrees, and a lot of experience get behind the long-term future of a company. So it's almost like, and again, I'm speaking for myself, not anyone else, it's almost like NASDAQ is more worried about liquidity and investors selling their shares than they are long-term investors holding, because the holding of those shares, I believe they think creates spikes in the stock, and they don't want spikes. They want, status quo. Again, my view from talking to dozens and dozens of bankers and dozens of CEOs and lawyers about why anchored investors have fallen out of favor. Now, it's getting better, I will say. We've seen some progress. They're loosening things up, and maybe it just takes time. But those are really the real differences. And there's some others too, but I'm not going to give you all the tidbits. You have to read the article when it comes out, but those are the main ones.
Killing me. One all. But hey, real quick on the anchor investor point, because I think that's pretty interesting right there. I mean, I'm not sure how much insight you have from the anchor investor point of view, but is that more symptomatic of the market? Maybe some of these guys want to diversify their risk within micro, small cap, nano cap versus like, all right, I'm going to take bigger bets on a fewer names and go from there.
No, this is purely a regulatory analysis. This is not talking to anchor investors. We get our data from the bankers.
Sure.
Like I said, there's about 42 microcap investment banks that we track in our data. Okay. And I want to talk about our data. Hopefully we'll have some time to talk.
We're going to get to that in a second.
But 42 investment banks, we talk to almost all of them regularly. And they tell us that, hey, we have almost stopped going to the bigger names to invest in these microcaps. And some microcaps deserve the bigger names because we know NASDAQ's not going to allow a T. Rowe Price to take 20% of the deal. It's too concentrated. Or any investor, maybe not T. Rowe Price, but another investor to take a large portion because they want liquidity. They want selling. They think, again, my view, that anchor investors who hold long take away from the float. And when you take away from the float and there's not a lot of sellers, price spikes up. And eventually it finds an equilibrium and comes back down. And that is what they're trying to avoid because the SEC is looking at this trading and saying, hey, this can't continue. Now, I have some other thoughts on why that happens. I know not a topic right now for this question, but that's really the landscape that's going on. And there's this tug of war between bankers and consultants and lawyers and CEOs and NASDAQ. And I believe, we all have an obligation as gatekeepers and ambassadors to our community and keeping our markets safe to communicate and collaborate and work together to help NASDAQ do whatever they need to do to make the markets more efficient, but also be a little bit more user-friendly in the process.
100%. All right, let's get to data. I was just at Roth this week. We're recording this actually on Friday, March 22nd. So I was there on Monday. And, I'm just going to speak anecdotally, and I'm going to defer to you on some of the data, obviously, that maybe supports some of the feelings or not. But, there was a mixed bag of folks that were like, impossible to get a deal done. There's a lot of companies that were trying to get IPOs, but, just banks can't get a deal done right now. But at the same time, I'm also hearing from a lot. I mean, look, for Planet MicroCap, even again, anecdotally, we've had more private companies that are going to be presenting than we have in years past because, they're maybe interested in accessing public markets. I don't want to speak for them, but, they're amongst an audience that's primarily there to invest in publicly listed companies. So want to get a better understanding of what's your sense of the IPO market right now, uplisting market, cross-listing. What's some of the data that you're seeing?
Yeah, so let me talk. We're actually publishing our 2023 MicroCap IPO and uplist year in review next week. It took us a lot to kind of get through the data because you really can't track it. It's hard to track. We have systems we use and we spend a lot of man hours tracking this data because you can't just type in MicroCap IPO and something comes up. I mean, our report comes up because we track it, but it's very hard. So let me tell you something that I think a lot of people find very surprising. And I talk to everyone under the sun. I always ask this question, How do you feel about the IPO markets, and what do you think the data suggesting are part of deals getting done? Invariably, most people say, oh my God, it's got to be down. It's terrible, because everyone's thinking of 2021 and the first quarter of 2022. And I'll tell you, the data suggests otherwise. You're going to be surprised about this, Bobby, but in 2023, there were 87 microcap IPOs. Again, IPOs with $300 million or less market cap on day one, 87 of them compared to 71 in 2022. A massive uptick in the number of deals, which everyone is surprised about. They're like, who's doing all these deals? Well, they are getting done. They're just getting done at smaller levels. And that's what people are seeing. People are seeing harder deals that are a smaller size of deal. We think the sweet spot in our data suggests that the sweet spot is somewhere between $6 and $8 million on an IPO. In 2022, the median offering size was $15 million for an IPO. Those 71 IPOs, $15 million. Money was still pretty plentiful in 2022. 2022. In 2023, the median offering size of a deal was cut in half, between $7 and $8 million. That's what people are seeing. Smaller deal sizes, but the number of deals happening have been up. Also, the average public offering price, which we track, have been substantially down too, from about $620, $630 in 2022 to just over $5 in 2023. So again, lower valuations, lower size of deals, lower offering prices have all contributed to the feeling, the undercurrent, that it's hard to get a deal done. And by the way, it is hard to get a deal done. But that's what people are feeling and seeing. But as far as number of deals, they've never been, never been on a more uptick in swing.
So is it better to maybe look at like aggregate amount raised post IPO 22 over 2023?
Well, we track secondaries too, but let me tell you this.
Okay.
This is another interesting statistic. In 2022, there was about $1.4 billion raised in the microcap, again, on that initial listing for IPOs. In 2023, it was $1.25 billion. Not a lot less. Yeah. I mean, because the number of deals were up, the deal sizes were down, but it all sort of shook out where it's not that bad. But I do feel, because the way the regulators have been taking their time, again, now having 2 clearances with NASDAQ, the company, and now the deal, it feels harder. And that's why we're hired a lot to come in as special counsel or just listing counsel or advisory counsel to kind of give our input on how to get through NASDAQ. There's some consultants that do this as well. I think we made a nice industry for ourselves on doing it from a legal perspective and helping the banks figure out what concentration and what distribution is right, helping companies figure out their selling shareholder table, their cap table, their legend removal, what is public float, what is not. But these are some of the issues that we face every day.
Very good. I mean, and then now when you look at the data on uplistings, how many got done in, let's say, 2022 versus 2023?
Yeah, that's a sadder story, unfortunately. And I will tell you, it's really because of this. I hate to keep talking about NASDAQ. They're going to yell at me again, but it is true. It is a fact. There's no emotion here. There's no supposition. It is a fact. When NASDAQ changed that rule, for the most part, a lot of people
which one,
in the industry,
the anchor stock rule?
No, when they changed the rule that you really can't do a simultaneous reverse split okay, and listing, that really hurt the uplisting market. Now, again, this isn't me speaking. This is the industry speaking. Bankers, CEOs, consultants, other lawyers have really had a visceral reaction to that, because on the one hand, they're out there saying, come to NASDAQ. Where we have, you can't trust your trading platform's liquidity or trading, but on NASDAQ, we're the, pinnacle of the world. And then they make you trade for 5 or 10 days post reverse split on that inferior, according to them, trading platform. Doesn't add up. But since they've done that, I'll give you some data here, which is really, really upsetting on the sort of uplist front. So in 2022, there were about 56 uplists done. 2022. In 2021, there were more, maybe like 70 or 80. But in 2022, there were 55. In 2023, there were 19. 19 uplists done.
Wow.
I mean, I don't know the math on that because I can't do the reverse math in my head, but it's got to be a 70% decline. Mainly because NASDAQ is the preferred choice of microcap companies, over 90% of market share. And when they changed that rule, the Uplist kind of just cratered. And it didn't crater just because they announced that rule, cratered because it reverberated through the marketplace where lawyers, bankers, CEOs, everybody soured on the Uplist process single-handedly because of that rule change. Also, not to blame them completely, the market also changed. It became harder to raise money. People were sitting on the sidelines, keeping cash, locked in accounts, waiting for opportunities. So it was a combination of things that was really led by this rule change that I think have contributed, terribly to the Uplist market. But again, as we talked about before, Bobby, CBOE is opening up that world of possibilities. And if the bankers and the money and the investors follow, that Uplist market will again be vibrant on CBOE. And we do believe we will see some loosening from NASDAQ on this rule and on the simultaneous reverse split and uplistings.
Hey, and I apologize if I may have missed it when you were going through the differences, but is the CBOE implementing that same rule, or are they?
No, so CBOE is much more friendly and flexible, and they recognize that if you're going to do a restructuring or a reverse split, as long as your offering price is priced at the $4 minimum, and you can do it simultaneously. So they don't need you to go back to your home country platform. They don't need you to go back to the OTC. They don't need you to trade for some indiscriminate amount of days to prove that you can get liquidity. The whole point of going to NASDAQ, New York Stock Exchange, or CBOE is to increase liquidity. Why would you trade on a, in their words, inferior platform and judge them based on liquidity? So CBOE has loosened that rule and been more user-friendly. And by the way, so is New York Stock Exchange. They will, under certain circumstances, allow you to do a simultaneous reverse split and pricing of an underwritten public offering for an uplisting transaction. So it looks like CBOE is taking a little bit more of a user-friendly approach, closer to the New York Stock Exchange on certain of these rules than they are on NASDAQ.
I mean, let's talk about the rule a little bit, because I mean, I think maybe I'm wrong. Maybe the data tells me something different, but it seems that, you do the reverse split, and wonder if NASDAQ is also reacting to the amount of potential delistings that they're experiencing. Like, all right, we didn't have this rule in place. Sure, we were getting more uplistings, because they could do the simultaneous uplist, raise, whatnot. Mm-hmm. But, we're still all right, great. They did that, they were on our markets for a year, maybe a year and a half, 2 years, and here they go. They're about to delist because they can't, meet the minimum bid requirements and that kind of stuff. So, I mean, on one hand, it's like, oh man, you did this rule, but at the same time, it's like, well, okay, there's a good amount of these companies that have done this, and now they're coming back down.
I hear your point, Bobby, but it's apples and oranges, and here's why. It is disingenuous to suggest that your platform on a higher exchange is so much better than the home country platform or the trading quotation system that you're currently trading on, namely the OTC, because of all the things that they market on: better liquidity, better exposure, etc. And then to say spend 10 more days on that platform as a measure to see if you qualify then for the higher exchange. The whole pitch is that the higher exchanges will produce, by definition, more liquidity. And by the way, the average time for companies to get listed is not, 2 weeks, 1 week, 2 months. It's usually greater than a year, sometimes 2 years, sometimes 3 years. So the company has time to execute, raise more capital, figure out their business plan, do things that will keep them listed. I really think, and a lot of practitioners think, that everyone is reacting to just the change in the global financial world. In 2021, everything was up. Companies weren't getting delisted. There was money everywhere. 2022, 2023, because of the interest rate environment, because of other global factors, things got tight. And all we're seeing is a function of people taking money out of the market, sitting on their hands, things tightening. Companies that went public in the bull market of 21 and the end of 20 are now not getting a free pass from these investors. They're getting a harder look, and prices are coming down. It's just a function of where we are in the world today. It'll change. The system will glut out. The market will, again, the market's doing fabulous on the large cap. As you know, NASDAQ is teetering on 40,000, hitting an all-time high. My only point is that this is not some big conspiracy to manipulate the markets and all these microcaps are terrible. We have to judge what is going on against the backdrop of what is going on in the world. And I'm telling you, this is all going to flush out, and companies aren't going to be delisted at the rate that they are now. It's just coming off a very tough, 12 to 16 to 18 months in all markets, not just the microcap. And that is a function why these companies, in part, execution is a big one, but in part, what's contributing to these delistings.
That's a fair point. So I guess my follow-up to that, and we're running right up about an hour here, so I think this will probably be my final question.
I'm just getting warmed up, man. You're doing a great job.
I know we could probably go for another 3, but I want to save a little bit for Vegas and all that stuff, because I mean, definitely everybody, I hope, if you made it this far, please join us in Vegas. Especially for this keynote Q&A, I think it should be fascinating. But as a follow-up to that, so if and I take your point, it's totally fair, everything that you just said. It could be a function of wider markets, type interest rates, all that stuff. So then I might ask you then, let's say we talk again same time 2025. Let's, in your opinion, let's say things change, let's say rates cut a little bit, CBOE continues to mature in their offerings, NASDAQ and NYSE, they do what they do, OTC does what they do. So how do you think the ecosystem kind of looks maybe this time next year?
Well, look, that's a great question, because I think about this a lot. While we are a law firm and we want to do deals and represent companies, ultimately we want to do the right deals with the right people. And we want to promote our industry and our ecosystem. One thing you have been wonderful at, Bobby, and your dad too, I mean, the whole company has been promoting this greater ecosystem of the microcap. You guys were the pioneers of that. I so appreciate that. I've learned from you guys over the years, and we have adopted this philosophy as a law firm. We're ambassadors to the community. We want everyone to succeed. The world is big enough to have competition, and we're happy for other law firms and happy for bankers. We don't begrudge anyone anything. But here's the answer to your question. I think that CBOE will continue to have some market penetration. I do believe that investors and bankers are going to follow, because there's such an undercurrent right now that NASDAQ is incredibly difficult. For better or worse, again, not me speaking, the industry speaking. But here's what I would like to see happen. And I'm working on this with certain other practitioners and certain regulators. I think the industry has to come together. We all have an obligation to the community, to this ecosystem, to help NASDAQ, help CBOE, help really all of us together to make this the most vibrant, safe, transparent community for emerging growth companies. And what I would like to see happen is all of them working together, from the OTC to CBOE to NASDAQ to New York Stock Exchange. I would like everybody to communicate, because right now it's very disjointed. You have one platform attacking another. You have another platform not wanting to communicate with the other. You have everyone blaming the SEC. That's not good for anybody. We should all come together as senior leaders in this industry. And again, nothing's going to be perfect, but we can at least try to make things better. And transparency and collaboration and communication are the hallmarks of what will make us better. So I see CBOE penetrating the market a bit. I see NASDAQ becoming more user-friendly. I think New York Stock Exchange kind of have always done their own thing, and they're going to continue to play a major role. But I think things will get more congenial, and I really hope that Lucosky Brookman, myself, you, and others who lead this industry will play a major part in bringing everybody together for the benefit of this entire ecosystem.
And Joe, that's a great place to end it. And you got my vote. So with that, Joe, where can our audience go and find more information on Lucosky Brookman?
Well, you can really find me on LinkedIn. I think our LinkedIn is a very good place to find cutting edge data that we put out, good topics, educational value, value-driven, thought-provoking things. LinkedIn is a great place. You can also find us at our, on our homepage at lucbro.com, lucbro.com, no K. I've gotten used to over the years of saying that. But Bobby, thank you very much. It's been great to be with you. I hope you'll invite me back for a follow-up, because we care deeply about this community, this ecosystem, and the microcap community at large.
100%. Joe, thank you so much for taking the time here today. Good luck, stay safe, and I'll see you in Vegas.
See you in Vegas.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.